Hi, my name is David Madhuva from Strathmore University Business School, Kenya, and I am one of the ACCA IAAER Scholars 2022. I am here to present my ongoing research work on accounting and financial markets. My research projects are under the guidance of Professor Elizabeth A. Gordon of Fox School of Business in the United States. I am very happy and pleased to mention that I'm the VP Africa representative in the Inspires Global Network. This is a global network that tries to bring together researchers and scholars world over and trying to work on responsible research, promoting responsible research, and getting people to carry out research that is capable of making meaningful contributions out there. Now, my research is highly informed by what the famous accountants came up with, especially JP Morgan, who talked about gold being money, everything else is credit. We all know that if you want to measure the true wealth of any economy, you may want to look at the real gold they are holding and the value of that gold. Currency should be backed by gold. Everything else is fiat or it's credit. But it is actually on this basis that my research project, buys a lot from, because we are focusing on financial markets. There's a lot of credit that happens. Credit is all about money, provision of money, right? Savings, investments, loan, borrowing, and all that. And therefore, my research study and project are centered around that. The first phase of my research project is on accounting and bank behavior, where we've been looking at how banks behave in light of what they do and what are the implications on the numbers that they give us. The next phase will be on accounting and financial cooperative behavior, including microfinance institutions. Again, we'll get to see how do accounting numbers play a role in these two institutions. And finally, we shall have a look at accounting and capital markets behavior. And as we look at all these things, we'll also be trying to have a look at the new reporting dispensations like integrated reporting and how these institutions are reporting on the 6 capitals. My work centers a lot around Africa's emerging markets with emphasis on the various regions or on Africa as a whole. And that is what my current research projects focus on. Under the first phase, accounting and bank behavior, we already have 2 works which have been completed and published. One is published in the Journal of Accounting in Emerging Economies, and the other one is published in the Journal of Applied Accounting Research. And the first study was looking at regulatory regime and the quality of bank earnings in the East African region. And then the next study was looking at basically the earnings quality, bank efficiency, and whether systemic banking and financial crises matter. Those are completed projects. The current research, which I'll talk a little bit about, is on IFRS 9 adoption, loan switching behavior, and earnings quality. And again, here we're looking at banks from an emerging economy. So the question here is, why a study on IFRS 9, loan switching, and earnings quality in banks? And this is an idea that was motivated by the need to link accounting earnings with borrower behavior following IFRS 9 implementation. We all know that IFRS 9 was implemented in 2018. For those who may not know, at least now you know it was implemented in 2000 after a long process of trying to work it out, going as far back as 2014 or even earlier than that. And now we have the standard. And this is to be applied by all organizations, right? Whether financial or not financial. But the standard has had significant implications in the financial services sector. And that's why my project centers around this standard. It has been 4 years since the implementation of IFRS 9. And what we've seen in our region is that bank regulators have been easy in enforcing fuller IFRS 9 adoption. Why has this been the case? Because of the expected implications on the earnings of these banks and implications on the capital of these banks. One of the anticipated implications, especially on bank capital, is a reduction in bank capital, hence affecting the bank capital ratios. And because of that, regulators have been, a bit slower towards mandating fuller adoption of this standard, just to avoid shocking the system or the banking system, given the regulatory capital requirements. And the same case applies, of course, to earnings. And we all know that when earnings are affected, then the capital position, whether tier 1 or core capital or tier 2 or institutional capital, will be affected to some extent. The other thing is there has been notable and interesting shifts in loan quality among borrowers. Now, depending on the loan quality of a bank's portfolio, definitely the earnings will be affected, and therefore the quality of those earnings could be affected. And we want to investigate that. For this project, we have two research questions. The first one is, did the adoption of IFRS 9 lead to greater income smoothing by banks, or did it lead to higher quality of earnings by banks? And the second research question is, what are the implications of IFRS 9 adoption on loan quality and switching behavior? What are the implications? As borrowers shift, and I'll talk a bit about the loan switching, what do we see happening to the earnings quality of those banks? The study is motivated by a study that have been carried out in this area, going as far back as 2003 by Ball et al., where we are told the adoption of high quality reporting standards is a necessary condition for high quality information, but not necessarily a sufficient condition. So you can see, like in our case here, the adoption of IFRS 9 does not necessarily mean we will be providing high quality information. Why? Because there could be incentives not to disclose high quality information, especially where there could be perceived penalties, either to the institution or to the managers or the board when they comply with these high quality reporting standards. A more recent study by Frankstrom and Lee, 2018, they talk about now this transition from IAS 39, which was on financial instruments, to the newer IFRS 9, which is again a standard on financial instruments. What is the focus here? In the prior International Accounting Standard number 39, the focus was more on the incurred credit losses. It was more backward looking, historical. But then now when you look at the IFRS's expected credit loss provisioning model, you find it is proactive, right? It kind of anticipates default and tries to model that. Of course, we have the model that we use to model the loan loss provision, where we look at the probability of default of each borrower. And then, of course, you model this as a function of earnings at exposure at default. And then, of course, that is multiplied by loss given default. So in a way, you are looking at a borrower taking a loan today, and you try to model default today for that borrower, which is very proactive, because you're looking at 12 months from today, the next 12 months, the following 12 months, and then you're able to tell where to place that borrower. And there's a need, of course, for banks to increase their capital to meet regulatory requirements. Now, that brings a bit of a problem, because it is anticipated that the newer IFRS will compel banks to make higher provisioning for the loans. The higher provisioning has implications on the earnings, a reduction. Ratios are likely to go down. So how will banks, balance that given the regulator? Because the regulator has requirements on capital. This standard is going to come and it will affect the capital ratio. So how do banks, balance that and make sure that they report quality earnings? Another study by Lopez, Espinosa, Omar Zaba, and Sakasa in 2021, they find no evidence of increases in discretionary loan loss provisioning to manage earnings and or capital requirements by banks. Now that's very interesting, because here we have a new standard, that is IFRS 9. We were hoping banks will report more conservative earnings, which are higher quality. But then we have a study here which is telling us there's no evidence of increases in discretionary loan loss provision. So in a way, it kind of points to potential implications of the IFRS 9, but it might also point to some behavior by banks to kind of manage this loan loss provision under the dispensation. And that's why we are asking, does IFRS 9 adoption really compel banks to smooth their earnings? Does it push banks to smooth their earnings? And if it does, then we look at the behavior of that. And that takes us now to the next slide, which talks about the loan switching behavior, right? And the adoption of IFRS 9 and the expected credit loss approach to loan loss provisioning necessitated a reclassification of loans into stage 1, 2, 3. And as you can see on my left there, you'll see how the loans are classified under stage 1, 2, 3, depending on the credit risk, that comes with the loans. Now, any loan switches from stage 1 to 2 to 3, that is a demonstration of deteriorating credit quality. Like, for example, if loans switch from stage 1 to 2, that is what you're calling a cliff effect. That is a significant increase in credit quality. From stage 2 to 3, of course, now that is like default. They're almost becoming defaulted loans. That again shows some increase in credit risk. Then from stage now, you can also have loan switches in the reverse, right? Where they're moving from stage 3 to 2, then 2 to 1. And of course, you can have loans moving from stage 3 to 1. The same case with the deterioration. You could also have loans moving from stage 1 all the way to stage 3, which is a very significant, event in terms of loan quality. Now, focusing on the credit quality improvement, where loans are switching from stage 3 to 2, 2 to 1, or 3 to 1, which would be very significant. The question we're asking here is, number one, what could trigger this shift? Is it managers of banks trying to follow up on these loans? Is it the borrowers themselves, finding it necessary to repay, maybe because of the implications of default? Like, for example, your credit rating going down. Or could it be other factors? Now, we can't forget that we've had a pandemic, that is a COVID pandemic, which affected a good number of borrowers. And that is likely to affect all these switches. The interesting thing is we expect credit quality deterioration to happen a lot, what we are calling the significant increase in credit risk. However, in the data that we shall show later, we see a very, very huge shifts in the opposite direction, where credit quality is improving. So we are still asking, do these switches have any bearing with the quality of earnings? Okay, because according to Lopez Espinosa, the expected credit loss provisioning should be more reflective of the bank's asset quality. So do we see that contributing to increased earnings quality by these banks? And if there could be any potential improvement in earnings quality, what kind of switches are contributing to that? Ordinarily, you would expect the positive, the credit quality switches, that is loans moving from stage 3 to 2 to 1 or 3 to 1, to have some bearing on the earnings quality. But we're asking, the other case could be, all right, the other switch could also contribute to the quality of earnings. Now, this study, we collect data from Fitch Connect for 7 banks in Kenya, Rwanda, Uganda, and Tanzania for the period 2015 to 2020. This is basically to allow an investigation of the periods before and after the IFRS 9 implementation. And this gives us 417 observations spread across the 6 years. So in this case, we are able to study 3 years before, 3 years after, and then we are able to investigate the implications of all that on earnings quality. To estimate the loan loss provisioning, what we do is we employ models that have been suggested by prior studies like Dalmaso, Lopez Espinosa, and we first estimate the loan loss provisioning as a function of the prior loan loss provisioning, the loans, the change in the loans, the non-performing loans, the change in the non-performing loans, and of course we bring in the earnings before loan loss provisions, plus a number of other fixed effects there. And that gives us now an estimate of the loan loss provisioning. Then now for us to determine the discretionary loan loss provisioning, here we kind of now get the difference between the observed or the actual loan loss provision that is given by banks as calculated, and how it deviates from the which is not positive. So in this case, now we are able to see what is the deviation? What is the deviation from the actual observed loan loss provision to the one we're estimating? Now, in this case, a larger deviation implies lower quality of earnings. A smaller deviation implies higher quality of earnings because it is closer to what we expect. Now, in response to the first research question, did the adoption of IFRS 9 lead to greater income smoothing by banks? Here we model our data variables using a two-step generalized method of moment estimator to model banks' earnings quality, measure the functional test and controls. Of importance here is the variable IFRS 9, where we are trying to investigate what is its connection, association with the quality of earnings as measured by discretionary loan loss provision. Of course, we do employ a set of some control variables which are useful in examining this. And these control variables are obtained from prior literature. Some very interesting control variables we include here is like the day one impact, where we measure the change or that here when there was a switch from IAS 39 to IFRS 9, and just trying to check whether that switch there might have had any implications. Of course, a switch in the loan loss provisioning. Then another very interesting control variable we include here is the supervisory intensity measure, which tries to also control for the level of enforcement, the strength of enforcement of some of these regulations in getting banks to comply with that. Now, alongside that, to test the IFRS implications on earnings, capital, and then the bank's earnings quality, we introduce now two variables here, one of which is the earnings before the loan loss provisioning, and the other one is regulatory capital. So we also want to test whether these two variables have had any significant implications on the quality of earnings. And we are more interested in the interaction, right? The interaction terms of these variables with IFRS adoption and its bearing on earnings quality. So like in the case of earnings before loan loss provision, we interact that with IFRS 9 adoption and check whether there has been any significant implication. Same case with regulatory capital. Here we are looking at the total regulatory capital and its interaction with IFRS 9, linking that with earnings quality to see if there is any significance. Now, for the bivariate analysis, in response to the first research question, we do a pre-post IFRS, kind of analysis, IFRS 9 analysis, and we want to check whether the loan loss provision, the earnings, the capital, did change significantly from the pre-IFRS 9 to post-IFRS 9. Starting with the loan loss provision, we find a significant change, a significant difference in the way loans have been provisioned for earlier and now with the IFRS 9. And that change is very significant, meaning the IFRS 9 dispensation, the IFRS 9 standard came with a substantial change in the way we provision for loans. Because of the expected credit loss approach, then the provisioning has substantially changed. Then in terms of the discretionary loan loss provision, we see the change there is very minimal, average of 0.014 to 0.015. And our T value there is not significant as such, but there is still a change, an increase. What does that small increase mean? Looks like the earnings quality kind of reduced a bit with IFRS 9, although that is not significant from our univariate, let's say, analysis here. Then we look at the return on equity. There has been a change. We find the return on equity has dropped actually, and that is a bit significant at the 10% level, given the t-test. But we might say, yes, the earnings have been affected, but not to a large extent, not to a significant extent. We also see notable changes in the earnings before loan loss provision and the regulatory capital, with the regulatory capital dropping, but this is again not very significant. Still on the first research question, our multivariate analysis using the two-step GMM results reveal that the coefficient, when you look at the coefficient on the earnings before loan loss provision, you find it is a negative 0.111, which is highly significant, implying that the earnings reported before loan loss provision have contributed to improved earnings quality, right, of banks. In a way, banks might have anticipated an effect on their earnings, and therefore they've been forced to, of course, smooth the earnings and make sure that the earnings reported are of a higher quality. Now, the other thing is the IFRS 9 coefficient. We find it significant, but not that much significant on model 1 and 4, meaning there could be some limited implication some limited contribution of IFRS 9 on the quality of bank earnings, although this is not very conclusive. The next is now addressing research question 2. What are the implications of IFRS 9 adoption on loan quality and switching behavior? Now, in this case, we test the loan switches, right, and model them against the earnings quality. So in this case, we are interested in the loan switch, like in this case, loan switch A, which could be any switch from 1 to 2, 2 to 3, 1 to 3, or the reverse, all right? 3 to 2, 2 to 1, or 3 to 1, all right? Whether positive or negative. And we want to model this as a function of those switches and the other controls, and of course, interacting it with IFRS 9 adoption. And then now we link that with the bank's earnings quality. Now, very interesting observations we find here. In terms of loan switches, we find quite a substantial number of positive loan switches. By positive, I mean improvements in the credit quality or reduction in credit risk, all right? So on loan switching, there are notable switches under credit quality improvement. So loans moving from stage 2 to 1, actually they're the most, which is a positive switch. 3 to 2, right? And then 3 to 1. And then we also find a little bit more loans moving from stage 1 to 2, mainly because maybe when the borrowers took the loans, they were in 1, then there was a bit of credit quality, drop. And that's why they moved to stage 2. But majority of the loans that we investigated and came across had demonstrated positive, credit quality improvements there. Now, looking at the multivariate analysis, we find very interesting results here, right? The estimation coefficient on the loan switch from stage 3 to 1, all right? Stage 3 to 1, meaning improvement in credit quality, is a negative 2.605, which is significant at the 10% level. That shows limited contribution, positive contribution, credit risk improvement on the quality of bank earnings. Limited, meaning these switches have some bearing on the earnings quality of banks, and banks might have to pay a lot of attention on those kind of switches to make sure that the quality of earnings are improved. The credit risk improvement coefficient overall, all right? All the switches from 3 to 1, 3 to 2, 2 to 1, the overall of those switches is also demonstrating a positive implication on the quality of earnings. Of course, the coefficient is negative 0.019, meaning that the earnings quality is improved, right? So what we find overall in these results is that positive loan switches, all right? By positive, I mean improvements in credit risk quality then translates to improved earnings quality, even though we cannot say that overwhelming, all right? So of course, the findings are a bit limited because of the significance, but at least we see some muted implication of those kind of, switches. Now, very important to note that the quality of bank earnings are affected by the loan loss provisioning that a bank makes. This might imply that banks usually refer to the previous loan loss provisioning, right? They always refer to it before reporting this year's earnings. And that, of course, has a bearing on the quality of earnings they report. And in this case, by the way, the implication is that the prior loan loss provisioning have a tendency to reduce the quality of bank earnings, right? That's very important. The other thing that we see in these results is that the diversification in revenue, like in this case, we are looking at income coming from securities, has also a bearing on the quality of earnings. It seems that the more diversified the income of a bank is, the less the quality of earnings the bank might report. Why? Because the bank is comfortable with the earnings, all right? They are more diversified, they have more other sources of income, and therefore the quality of their earnings might not be that high. Now, what are the implications of this kind of research? One of the implications is that bank regulators need to consider quicker and fuller implementation of the IFRS 9. As I said earlier, that when the IFRS 9 came into force, we've seen regulators taking a very cautious approach towards the implementation. Why? Because of the likely implications on the banking or financial services space. But you're saying, because the IFRS 9 is a high quality standard and it comes with greater provisioning and improved implications on the quality of earnings, though not overwhelming, then we feel the earlier we adopt it, the better, instead of having this staggered, cautious, conservative approach to it. For us to have a better view of the quality of earnings of banks, it's important to have a fuller implementation. The findings offer an avenue to examine bank and even borrower behavior in the wake of newer loan loss provisioning, recognition, measurement, and reporting dispensation. What do I mean by this? We found the loan switching behavior having some implications, however muted, on the quality of earnings. And therefore, this is very important because banks might behave differently given the different switches in the loans. Okay. Now, what are the next steps? We hope to seek a larger, more representative data set, hopefully all the banks in Africa, so that we can have more conclusive results, right? We are happy with the first set of results, but since this is work in progress, we hope to get more information that can help us. And then we also hope to employ more robust analysis, like, for example, the employment of net loan charge-offs in earnings quality, such as what has been proposed in BASU, Returns in 2020. And we hope this will improve even the robustness of the results that we are reporting. And as I come to a conclusion on this study, this is a study that is timely. It comes 4 years after the implementation of IFRS 9. And we hope that through this project, we'll be able to help inform the IASB standard setting process in terms of the implications of standards that are currently in place, and help inform further discussions around this area. And of course, very importantly, getting insights from emerging and developing economies who seem to be a little bit cautious, right, in terms of implementing these newer financial reporting standards. Thank you very much. And I hope we can engage more for your insights on this project. I'll be very happy to receive your comments. Any ideas that can help improve this project are most welcome. For now, we've come to the end of my presentation. Thank you very much. Thank you. Thank you so much.